Good afternoon, guys. So I want to officially welcome us to today's webinar. For those of you who today is your first time of joining the webinar, I'm going to be your facilitator. And today we are going to be looking at a very important concept when it comes to trading, which is marketing efficiency as regards imbalance. So the objective of today's class is for you to know the types of imbalances that exist in the market and why these things exist. And most importantly, the rationale behind why markets often than not create this imbalance and why institutions always come back to rebalance the market before continuation in the direction of the price delivery. So in a nutshell, we're actually going to be looking at this, why they exist, and most importantly, how you can take advantage of it to use it to increase the probability of a setup. All right, so let's get started, guys. So basically, when you're talking about markets, market exists in two forms. There's an efficient market and there's an inefficient market. Now, an efficient market is a market that is balanced. So if you're looking at price delivery, you're looking at the market that is actually a balanced market. A balanced market is a market that is in a range, basically, right? So when you're looking at an efficient market, it's a market that is relatively within one place. Like this right now, you see that the market is actually moving within this range. If there is an expansion, either to the upside, right? This market is no longer a balanced market. There is imbalance. And whenever the market is done with the business up here, right? Is going to come back to rebalance this price here before continuing to the upside. And basically, this is how the market moves every single day, every week, every month, year to year. Now, when it comes to price delivery, there's what we call efficient and inefficient price delivery. If you look at this price movement from here, represented by the candles, to this last one, this price delivery is efficient. Why is it efficient? There is no place that there is a gap in the market. When there's an efficient price delivery like this, the market will have no reason to come back. That is to say that if somebody who understands the concept of efficiency and inefficiency in the market is looking at this price delivery, we definitely be looking for reason to enter this trade from here, as long as there is no institutional reference point below it. The reason is what makes market retrace is to balance the inefficiency that exists in the market. If you look at this place, since the price delivery is efficient, you don't expect bigger retracement like this before continuation to the downside. Now, basically, if you're looking at the market that is efficient, you're most likely going to actually be using the candles, correction of the candles, and you enter targeting the next institutional reference point. Now, the question is, if you're looking at this for the very first time, you may really not understand what we mean by being efficient and being inefficient. When we say a price delivery is inefficient, we're actually looking at the range of the candles in relation to the next candle. Now, if you start from this place, it means that this was the last buying candle before the market started selling. Now, if you take a range of 3 candles, let's say we are considering this candle and this other candle. So this is a range of 3 candles. Now, this is a price delivery, bearish price delivery. So for us to establish if the market is efficient or inefficient, we're going to be working with the low of the first candle in that range of 3 candles and the last candle, which is the 3rd candle in that range. So the low of this candle here, so the low of the first candle is this. So you're going to actually highlight this low. And the high of the 3rd candle is this. Now, if you look very well, you will see that the bodies of these candles, the candles are actually interwoven, all right? In a scenario where we see this high, the low of the first candle being traded into by the high of the third candle, it means there is no gap that exists. There is no imbalance. Market has actually rebalanced itself. Now, if you take the range of the next set of candles, starting with this is 1, 2, 3. This is the high, the low of this, and the high of the third candle. You see that they actually traded into each other. If you take the low of this and the high of the third candle, they actually traded into each other. All right. Now, if you continue in that order, which this one doesn't have a wick, of course, this one, there's no gap, right? If you continue in that order to the last 3 set of candles, which is the low of this guy and the high of this. So basically, there is no place that a gap exists in this market, and hence the market is efficient market. This is efficient price delivery. If you're looking at a market that is going down and price is being delivered this way, you do not expect a deeper pullback before the market continue going down. Now, if you compare this with relation to this other price delivery, if you look at this price delivery here, you see that this price delivery is inefficient in the sense that the market actually created a lot of imbalance while going up. Now, what I mean by that is, if you look at, this is the last selling candle on this leg, right? This candle. So if this is the last bullish candle, and we're taking the range of these 3 candles, 1, 2, 3. This is the high of this candle. So you're considering the high of this candle. So the high of this candle and the low of the third candle. The line hand is not straight. You see that there is a tiny gap that exists here. All right. You consider the range of these 3 candles, 1, 2, 3. This is the high of this candle and the low of the third candle. You see that they did not trade into each other. There is a gap that exists here. This is imbalance. You take this one, this range of candle and this range of candle. You see that there is a gap that exists. Now, if this market is done with this impulsive move, there is high chances you're going to see a deeper retracement to come and close these gaps. Because there's one thing the market doesn't like. Market creates imbalance to rebalance it. You get. Now, the only people that has what it takes to create this kind of price delivery in the markets are institutions. So when there's institutional involvement in a price delivery, you expect market to have imbalance. So most of us that understand the way we approach the markets, you know that we approach the market from institutional perspective. And our job is to follow their footprints in the market because they are the one that has the money. And the market tends to move in their direction. So you understand where their interest lies, and your job is to keep following them, follow the money. So basically, when they create this gap, they are going to come back to rebalance these markets and now continue up. So even if you're not in the market and you have missed this move, right? You already know where most likely the correction, when the market starts the correction, where it's going to end, a continuation to the upside, which is the continuation of the impulse move or the next impulse move you're expecting in this direction. Okay. So when it comes to the market, there's a lot of market inefficiencies or imbalances that exist, right? So, but for the essence of this class, you're going to consider these two because these two are the most prevalent, most especially number 2, the ones we are going to see a lot on the charts. So we have volume imbalance, we have fair value gap, which is also another type of imbalance. We have weekly opening gaps, we have daily opening gaps, and we have monthly opening gaps. So all these are inefficiencies. And now when you talk about volume imbalance is a scenario where you have a price delivery that the 2 candles or the 2 pair of candles has to be the same color. So looking at bearish candle or bullish candle. And the bodies of the two candles are actually not connected. Rather the wicks. If you look at this, you're looking at the body of this candle is not connected to the body of this candle. But the wicks, most times the wicks we may even not even connect. But with the bodies here, all right. So in a scenario where you're looking at the bodies of the two candles or the two pair of candles you have chosen not being connected to each other, you know that there's a volume imbalance that exists that very place. Now, if you look at this example or looking at on this slide, you see that the body of this candle, which is the first candle, is actually not connected to the body of the second candle. That is not the case with this one here. You see, the body of this candle is actually connected to the body of the next candle that opened after it. The same thing here. If you look at the body of this candle, after this candle closed here, the body of the next candle is actually connected to the body of the next candle. But looking at this one, the reverse, you see that the body of this candle is not connected. So we have this kind of connection. You know that there's a volume imbalance that exists there. Now, most times when this exists is often than not orchestrated by fundamental events in the markets. When at the close of the next candle, there is a news event that hits the market jumps in a particular direction, continues in that direction without deeper retracement that are actually. So upon the close of this candle means the market jumps a bit higher, opened and retraced a bit, then continue in that direction. When this exists, you expect that this market, after he has done his job, is going to retrace exactly, close this gap, and then continue. That's how you take advantage of it. You're going to be looking at all those in the chart. Then fair value gap. Fair value gap is the one you're going to see a lot on the charts, most especially those of you that are going to be advancing yourself on the angle of smart money concept. So a lot of smart money concept incorporates the use of fair value gap in both entries and institutional, both entries and POI, because fair value gap is a very important point when it comes to POI, because according to ICT, fair value gap is the number 4 in that order of institutional reference points where we look at to consider and take our decisions. In a price delivery, there are zones that institutions prioritize. They expect most times they want to continue or reverse the market from this institutional reference point. So in the order of priority, fair value gap is number 4 there. So it's a very important zone where you see there's a fair valuation in the price of that asset. Now, talk about fair value gap. Fair value gap is equally a 3 candlestick price delivery, that's a situation where you have the low of the first candle not being connected to the high of the third candle in a bearish price delivery. And in a bullish price delivery, you're having a pair of 3 candles where the high of the first candle is not connected to the low of the third candle. Okay, now what I mean by that is if you look at this price delivery here, you will see that why the market was dropping could be that, okay, most likely we have a resistance zone here, right? And when market run into this resistance like this, printed the last bullish candle, and from there we sustained serious bearish momentum and market started coming down. So at the close of this very first candle, the second candle opened, right? Close of the second candle, the third candle opened without really doing a deeper retracement to ensure that this price delivery is efficient. Now, when you have this kind of scenario, price delivery, somewhere below here, you're going to see this market retrace back, rebalance this market, and continue going down. Okay? The same thing here. So what you're actually looking at in fair value gap is if you have a setup that involves fair value gap, our job is to detect this and wait for a balance. So in case we miss this, a return of this is where we are considering entering the market. All right. So basically, in summary, what I'm trying to say in essence is if you have a 3 candlestick price delivery, right? You just need to, if it is bearish, you connect the low of the first candle and the high of the third candle. They are not interconnected, you know that there's a fair value gap there. And the reverse is the case in a bullish price delivery. Now, it's very important to make it clear, if I pay attention now, because that is what confuses a lot of people when it comes to fair value gap. Now, it's important to know that the colors of the candles involved must not really be of the same color. You can have this candle bullish, right? And the rest bearish. There's still a fair value. You can have this candle bearish and the rest bullish. As long as the high of this candle is not connected to the low of the third candle, there is still a fair value gap that exists there because there is still gap, there is still that imbalance. Markets will still come back to rebalance it. Very important. Just that was clear. Now, going into the market, most of the times, a good number of us have challenges on how to trade this. Okay. Now, if you must trade fair value gap, you must understand the midpoints, what they call the consequent encroachment line. The consequent encroachment line is the 50%, which is the midpoint of the fair value. Now, when you mark your fair value, which is the imbalance, the high of this first candle and the low of the third candle in a bullish price delivery. Here you can see now the 3 colors, the 3 candles are not the same color. You can have, you see this one, this is bullish, bullish, bearish. But you have to highlight the high of the first candle and the low of the third candle. Of course, we are paying attention to this range. Now, the range of these 2 lines, 1, 2, the half of it, which is the 50%, is what they call consequent encroachment line. So if you're trading fair value gap, this is your entry point. So you're going to actually take the price that actually correspond to this midline. You take the price that correspond with it on this price axis, and that is where you enter the market. Okay. The stop loss, of course, below the vector candle responsible for that imbalance. All right. So if you are trading fair value gap, right, these are the most likely places where you should put your stop loss. Now, for those who trade fair value gap and want to enter based on fair value gap and your stop loss and use stop losses based on the fair value gap, it means that you're entering at the consequent encroachment line, right? If you enter at the consequent encroachment line, which is somewhere here, your stop is at the low or just below the low of this vector candle, which is the momentum candle that created that shift and responsible for the imbalance that exists in the market. Okay, this is one of the ways to put your stop loss if you're considering just the fair value gap. Now, if you're looking at even a more safer place to put your stop loss, then they can put it at the other block, which is the last bearish candle before the impulsive move. You put it just at this other block. But honestly speaking, the safest place to put your stop loss is at the swing point, which is this last one. That's the safest place because most times, if the liquidity needed to move this market is not enough, most times you see this market here, ordinarily they should come here and move from here. But sometimes you can see these guys come here, shift a bit, and they will come back, run this liquidity here. If enough money is generated, they will shift from here, but you're no longer in the trade because your stop loss is just below here. Now, there are instances where they will even come here and trade into the wick of these candles. And from there, they move. So if you are here, you're already out. But most times, they're going to respect this low if it's actually a protected low before going, because this is a swing point. All right. So if you have your stop below here, basically, it's going to be to a reasonable extent safer than when it is here or here. So guys, I'm going to unmute us to ask our questions. So one more. So if you are trading fair value gap, there's what they call fair value gap inversion. So this happens at reversal points. The fair value gap inversion happens at reversal points where you see a zone where you're supposed to be selling with turn to a zone you should be buying with. Now, fair value gap inversion is a scenario where you have double fair value gap. You see this market white coming down. We had this fair value gap. Then while going up, we expect the market to respect this and go down, but we now see another fair value gap into this zone. So you have double fair value now on this zone. You're going to be using the same fair value gap, but this time around, you're buying with it. So at the return of the consequent encroachment line, you're entering your buy, stop below it, you can use the other block or the swing point for continuation to the upside. So inversion simply means fair value gap flip. So when you see a bearish fair value gap flipping to a bullish fair value gap, that's what we mean by inversion. So guys, it's time for question. Ask your question. Otherwise, we go to the chart and you see how this is done live in the market. So you are muted. You can ask questions if you have any challenges with what we've discussed so far. So you can just unmute yourself and ask your questions.
Okay, so I have a question.
Okay, go ahead, sir.
Okay, my question is, will every imbalances or fair value gaps be closed? Will the market close every imbalances fair value gap, possibly in a swing or in a trending market?
Okay. So the truth is, the markets will definitely not be able to close every imbalances that exists in the market. You get, but we consider it, we use it to frame a setup, because most times if you're looking at a POI and you're framing an entry, you use fair value gap as a potential selling point or a potential return for a buy. Okay, so there's what they call institutional reference points. I think there are about 7 of them. So you have mitigation block, order blocks, fair value, order mitigation block, breaker block, fair value, order block, rejection block, hold high and hold low. These are basically where institutions prioritize. So when you see a market that is going down like this, right? Everybody knows that is bullish, is bearish rather, okay? And this is the most recent impulse leg to the downside. So there are most likely, everybody knows that the market is selling and they should be looking for selling opportunity. But the question is, where will they start selling from? The market can start selling from here. The market can come back here and sell. The
Sorry,
market,
sir, we can't see your screen.
sorry, apologies. Oh, thought you guys were seeing. Apologies. Hope you can see it now. So what I was saying is, if a market is bearish, you're looking at a bearish market, right? You're looking at a bearish price delivery like this, right? And this is the most recent impulse leg to the downside, okay? And what it simply means is that as long as the market is still within this range, we should be looking for sells. So our selling range is from this high to this low. But the question is, this market can correct back to this previous low and go down. It can equally come back to this swing point and go down. It can as well come back to the midpoint somewhere around here and still go down. Now, the problem you're going to have as a trader is when this market starts this correction from here, you know that the correction has started. The problem you are going to have is, should I sell from here? Should I wait till here? Or should I wait from here? Now, there are instances where you now wait for the market to come here. And what you're now doing is, okay, this, if I use my Fibonacci, I know that this market is bearish and they say we should sell at premium zone. Premium zone is zone above 50%. So it means that this market has to, I should be looking for selling opportunity from 618 upwards. Okay, 618 upwards, that's where I want to sell from. Okay, now there are instances where you now use this to sieve low probability zone from higher probability zone. By implication, you will neglect this zone. I just see this market move straight to this zone and drop straight from there. I will be like, I would have even included this zone as my POI. Okay. Now, what we are saying by that is when you know all the institutional reference points and know them by their name and how the institutions prioritize them, you take in all these zones into consideration. Your job is to mark them and wait for price to come there, and you observe the reaction of price on those zones. If you see commitment that the price is showing commitment on this side to continue, you enter from there. Because there are sometimes market price does not do deeper retracement before continuing. Okay. So what we are doing is this market can create a fair value gap here to answer the question somebody asked, and it come back to this breaker block and continue down, leaving this fair value gap unbalanced. It doesn't mean that it may not come back there. It can still come back there in the future. But right now, the interests of the institutions are not yet on this zone to rebalance it. So there is serious money they're after there, chasing downwards. After that, they may actually come back here. But why we are learning all this is to know that is the point of interest where price come back to often than not. Now, look at, this is the chart we're looking at right now is GU. Okay. So this GU charts. And if you look at GU right now, GU is bearish. This is 1 hour time frame. Now, but those of you that we call this trade live, right? Now, I want to show us something. If you see what price did here, in this price they leave here, you see that going to line charts, see that basically actually there was a break of structure here. The market took out this low to give us a lower low, meaning our trending range now has shifted from this high to definitely this low. So as long as the market is within this range, you should be looking for selling opportunity within this range. So the question is, where is price going to come back to, right? So you go back to candles, you now see that we've got this other block here, and we've got this fair value gap here. That fair value gap is actually the range. So this is the high of the first candle and the low of the third candle. They are not interconnected, right? So now there are people that this zone is valid, this zone is valid. They are all institutional reference point. Market can come back to either of them and go down. Now in this regard, you see where the market came back. it came back exactly on this fair value gap. So like what we saw on that presentation slide, we say we are going to be selling exactly at the consequent encroachment line, which is the 50% of this fair valuation. All right? That's where our entry is going to be. Our stop is going to be at this vector candle, just a little bit above it. You want to be super safe, a little bit above the swing point. Then you target the low that produced it. That's it. Target this low, exactly this low. And simple trade, you're out of this trade. Whatever happens later is no longer your business. Of course, you can take 50 to 70% of your positions off here and you ride the rest. So this is basically how we use it to frame trades. Now, most times you're looking at a setup, definitely this is not the only confluence you need to see in a trade. But basically, is one of the confluences that we use to increase the probability of a setup. All right. There are other stuffs like liquidity and the rest. So by the way, tomorrow we're going to be looking at basic liquidity concepts and the rest. Okay. So this is basically how we use it, guys. So ask your questions before we call it a day. Start incorporating all this in your trading.
Okay, good afternoon,
What
sir.
about
Okay, go ahead.
okay? What about if you have two fair value gaps in the same market direction? Which one do you consider?
Okay. Very important question, honestly speaking. Like in this order now, we have two fair values. You have another one here. Okay. It's another one on this zone. Okay. Now, when you have this kind of scenario, you consider the one that is closer to the other block, which is the origin of that impulse move. So basically, if you use your fib level, you're going to be looking at a scenario like this. You can see this one is actually below the premium zone. So by default, using others, elimination method, this is going. But basically, the way I approach the market, I consider the one closer to the swing point, which is the other block responsible, the origin of that impulse leg. So in a bearish price delivery like this, we're looking at the closest one to the origin, which is the swing points. So this red represents our swing points, looking at this range right now, right? So this is the new range. Basically, that swing ended somewhere here. Yeah. It's the origin of the new zone to this. All right. So to answer the questions, the one closer to the origin is the one you consider.
Okay, good afternoon, sir.
Good
Thank you
afternoon.
so much for your teachings. I'm a beginner, just my first time learning Forex trading, and it has been interesting through your teaching. Thank you so much, sir. But, sir, I want to ask a question. Why do we sell in bearish market and buy in bullish market? Because normally in the normal market, we buy when things are going down, and then we sell when things are going up. But in Forex, we sell in bearish and then buy in bullish. I just want to know. Thank you, sir.
We sell when price is going down, and we buy when price is going up. But the thing
Why
is,
don't we buy?
why don't we do what?
Okay. I said, why don't we buy when it's bearish, when it's going down, and sell when it's going up? Thank you.
Okay, so this is it. So let's use these two ranges now as a reference point. Okay, these two zones. Okay, So if this zone, let's say this zone now is a support zone, and this other zone is a resistance zone. So let's say we are looking at price, and price drops from here. Okay.
Okay.
And now correct like this and drop again.
Okay.
Now,
Okay.
as traders, this is all we need to know that this market is going down. Why? We need a trend. How do we know a trend? We need a high and a low to establish a trend. Not just that,
Okay.
we need the market to show a defined pattern. So we need a lower high and then a lower low. Once market show this confirmation, it is confirmed that this market is interested in going down. Okay? So once you confirm this, the next thing you should do is you now know that the market is going down. The question now is, you know that you want to start selling. Once you know that the market is going down, it means that for you to make money in such a market, you should be doing what the market is doing. Since the market is going down, you should be looking to take advantage of the downward movement, which is buy. Because actually, how we make money in Forex is, we make money because basically what we are doing in Forex is we are trying to forecast price movements. If price is ranging here, and I now say that from here where this market is, let's say is at here now, and also, okay, from what this market has been doing, it's going to go down. And I sell here. Since I've said it's going to go down, and I now sell here. I sell at this high. Sell at this place where the market is now. I say, okay, I'm selling here. I'm targeting this low. Since it has been going between this and this, once it gets here, you go back. And also, okay, just in case it refuses to go down, get here, take me out. If this market do as I have said, because it's what it has been doing, if it goes down, I will make money because I predict it's going to go down. But if it goes up, I will lose money. So the way we make money from Forex is you knowing that market wants to go down, and you now predict down and take advantage of that movement to the downside. So you make money when you sell and price goes down, and when you buy and price goes up. But the question is, how do you know that price wants to go down so that you can now sell? So this is how you know. With this price, with this structure here, this is how you know. But even as the price wants to go down, there are premium zones. You can come and sell here, not that it's bad. If you sell this place now, not that it's bad, where price is now. But the difference is that this trade will only be safe if you put your stop loss at this high. And it means that this market can be at the liberty from here to start going up till it gets here before going down. This movement from here to this place is huge drawdown and it can blow your account. So what we want to do is that since we know that this market is actually range bound between this high and this low, we already know that it wants to go down between this low and this, right? You know, from here, it can start going up, doing correction, but this correction should not take out this high. So what we want to do is, we don't want to see all this drawdown, because this drawdown, if you are still on, let's say $100 or even $1,000 account, depending on loss side, you can actually blow it. We now say, okay, we are not going to enter here. We are going to wait till it come up a bit. It gets here. You now enter here. And we target this low or even here. That is why most times people look at it like we sell when the market is going up. The upward movement is going, it's not the actual movement, it's a correction. So the actual movement is the impulse move, which is the direction. So the market does not go in a straight line. It doesn't go like this. Even when it's going down, we know that ultimately, right, the way price move is that when it leaves this resistance, we are coming to this support. But it's not going to drop from this zone like this, from here to this place in straight line like this. This is how it's going to be moving. It will go like this, do correction. From this place, he has taken out this zone. He come back here again, watch all these things, correct again, come back here before he gets back on this zone. This is how it's going to go, right? So since you know that it's going down, you know that the corrections are not going to last and they are short. So your job is to know where the most likely place where the correction will end and know when it has ended and it now enter. If you can know the exact place every correction will end, that is the best place to enter any trade. That's why you hear about sniper entry and the rest. So basically, we do the same thing, but the difference is just that most times traders don't want to be in the drawdown or in big drawdown before the trade goes into profit. Because depending on your exposure, if your exposure is very high, that drawdown alone can blow your account. Trust I answered that question.
Yes, sir. Yes, sir. Thank you.
Yes, sir. Hello, good afternoon, sir.
Good afternoon.
Yes, sir. Please, I have a question. I was looking at gold this morning. So I was looking for a buy, but I realized on the 15-minute chart it was a pullback, but on the 5-minute chart it was a break of structure. So I got scared to take the trade, but after which, when the trade came back to my demand zone, it actually moved very well to the upside. So I don't know, is it that I should always prioritize the 15-minute demand zone and ignore the change of structure, the change in character in the lower time frame, or how?
Okay, so basically, if you are trading gold, I think the very first thing you need to do is you need to check the structure, depending on the type of trader you are.
Yes, sir.
Okay. So
Yes,
if
sir.
you are more of a day trader, that's where you can actually be looking at the lower time frame.
Yes, sir.
But if you're not a day trader, it may not really be of great essence. Okay. Now this is let me go to 15 minutes. Gold.
Thank you, sir. Yeah. That was around 9 p.m. in the morning.
9 p.m. in the morning. 9 a.m.
9 a.m. Sorry. Around 9 to 9:30. So it got back to a demand zone.
Okay. So
Yes,
9
sir.
a.m. in the morning is somewhere around here. This is
Thank you, sir.
9:45,
Yes, sir.
10 o'clock. So if 9 a.m., this is 9 a.m. candle,
Yes, sir.
9:45, 9:30, 9 o'clock. So this is 9 o'clock candle, right? That
Yes, sir.
candle is a bullish candle. So it was 8:45 that was a bearish candle. Now, if you look very well, you see that this was a decision candle the market formed after that time, representing equal in strength.
Yes, sir.
Okay.
Yes, sir.
So after the market gave this candle, so around 10 a.m., between 10:45, 10:15, 10:30, the market actually retested before going up. You understand? So what's the
Yes, sir.
question now?
The question is, I went down to 5 minutes. On the 5-minute time frame, it is a change of character at that zone when the market came back.
Mm-hmm.
So
There's no
that's why
change of character here.
there isn't, sir.
So you're looking at this as a change of character.
Yes, sir.
Now, it's very important to know this, and I think this is where a lot of people lose, actually enter wrong bias for a setup. Now, if you are looking at stuff like this, right? If market
sir.
is not at a POI from the higher time frame, ignore it. These are
Okay,
just
thank you, sir.
impressions. Let's say as you're looking at 5 minutes, this zone where this is happening, like this, has to be a higher time frame POI, either another block from the 1 hour or 4 hours or even daily, before you can start respecting this kind of stuff. Otherwise, these are just liquidity generation. This liquidity was generated for this zone to work. So basically what you did was change of character, then this should be another block. You are selling inside here. No. Good right now is even facing a bullish, stuff like this. Very wrong. So this is not a valid zone. Change of character should only be honored at a POI. If the market is not at a POI, ignore 100%.
Okay, sir. Okay, thank you very much, sir.
Hello, sir.
Yep.
Thank you very much. Sorry, just a quick one before you go. As beginners, is it advisable to stick to multiple pairs, or what number of pairs would you advise at least for starters? Is it 2? Is it 3?
As a
is it
starter,
5?
as a starter, is to a reasonable extent dependent on how free you are with time. So if you are not a very busy person, you can start with maximum of 5. If you're a very busy person, stay with 1 or 2. But if you want to actually understand Forex very fast and actually see results in a short period of time, you need to stay with 1 pair. You need to stay with 1 pair.
This is deep. Thank you, sir.
Yeah. All right, guys. See you tomorrow. Thanks.
Okay, bye, sir.